If you want to invest in stocks, there is a crucial term you need to know: diversification. With an S&P 500 or a total US stock market index fund, you will not only diversify across many different companies, but accumulate wealth alongside the stock market in a safe way. You should be including one of these two indexes in your investment portfolio, and I'll explain why. In this video, you will learn what is the S&P 500, what is the total US stock market, the S&P 500 and total US stock market ETFs, a comparison of the ETFs VOO versus VTI, and which is better. The S&P 500 stands for Standard & Poor's 500 Index, which tracks the top 500 largest US companies. The index is regarded as the best indicator of all large cap US equities, aka the performance of large company stocks. Okay, so Standard & Poor's, confusing name, right? The name is from the financial services company S&P Global, where in 1941 Standard Statistics merged with Poor's Publishing. S&P Global is known for creating investment indexes which track different parts of the market. Their most popular one, S&P 500. The S&P 500 is a market capitalization weighted index, a fancy way of just saying companies with a higher market capitalization make up a larger percentage of the index. Market capitalization, or market cap, is simply the company's worth on the stock market. It's calculated by multiplying the stock's current price with the number of shares open to investors, us. Let's take a look at the market capitalization of the top 5 holdings in the S&P 500. We have Apple at $1.97 trillion, Microsoft at $1.58 trillion, Amazon also at $1.58 trillion, Alphabet, otherwise known as Google, at just a bit over $1 trillion, and then Facebook at $744.22 billion. Even though the S&P 500 contains 500 US companies, about 20% is made up of just the top 5 holdings. The greatest thing about index funds is that it's self-cleaning. The companies valued the highest rise to the top and make up a larger percentage of the fund, while the allocation for smaller companies valued less make up a smaller portion of the fund. The total US stock market tracks the entire US stock market, meaning it contains all US companies publicly traded on the stock market, ranging from large cap to small cap companies. It contains about 3,500 US companies ranging from large cap to small cap companies. This means all the companies in the S&P 500 are included, as well as all the companies not in the S&P 500. We're going to compare the two indexes and determine whether or not the addition of small and mid-cap companies makes a difference in long-term growth. The S&P 500 and the total US stock market are two indexes. To actually buy the indexes, you need to do so through a low-cost mutual fund or an ETF. I have a detailed video explaining the differences between ETFs, mutual funds, and low-cost index funds, and I'll link it here in the description below. To compare the S&P 500 and the total US stock market indexes, let's compare the ETFs for both. There's Vanguard's VOO for the S&P 500 and Vanguard's VTI for the total US stock market index. In terms of holdings, Vanguard's VOO contains 509 companies, while Vanguard's VTI contains 3,529 companies. Keep in mind that VTI contains all 500 companies within VOO. In fact, about 80% of VTI is VOO. The expense ratio of both ETFs is the same at 0.03%. This is extremely low because the founder of Vanguard is John C. Bogle, which is credited for creating the first index fund. Vanguard does not have to adhere to any private investors because Vanguard is owned by its funds, who are in turn owned by investors like us, which means Vanguard's interest is directly tied to benefiting us. The dividend yield for VOO is 1.28%, while the dividend yield for VTI is 2.02%. Let's take a look at the historical performance for both ETFs. I'll break down the average annual returns for the 1, 5, 10, and since inception year marks. And keep in mind that annual total returns includes capital appreciation, dividends, and expenses. Since 1 year ago, VOO returned 11.87%, while VTI returned 10.82%. Since 5 years ago, VOO returned 11.44% and VTI returned 10.87%. For the 10-year mark, VOO is 1 month shy of being founded 10 years ago, but we'll take a look at the 9-year and 11-month return, which is 14.02%, with VTI returning 13.58%. For performance in a longer term horizon, like 15 years out, let's take a look at VTI versus the S&P 500 index itself. The historical performance has been gathered by Morningstar, and the S&P 500 TR stands for total return, where dividends are reinvested back into the fund. The S&P 500 index outperforms VTI for 1, 3, 5, and 10 years, but at 15 years out, the average annual return of VTI is greater than the S&P 500. The addition of small and mid-cap companies gave VTI a slight edge in growth over the 15-year time period. And at the time of making this video, VOO is worth $311, while VTI is worth $172. So which is better, VOO or VTI? They're both tremendous investment vehicles that offer diversification and growth with the stock market. The S&P 500 actually comprises about 80% of the total US stock market, which is why the returns of VOO and VTI are very similar. One could say the companies in the S&P 500 are less volatile, especially in a capitalistic economy like the United States. Large companies are considered more stable because they have the money and resources to stay afloat in troubling times. One interesting thing to note is the Google effect. The night Google was announced to join the S&P 500, the company's stock price shot up 7.3%, all in one night. By simply announcing that a company will join the S&P 500 may make the stock jump up. This can be seen as well with the recent announcement of Tesla in the S&P 500. Those who held a total US stock market index fund benefited from this because they already owned Google before it was added to the S&P 500, while those holding an S&P 500 missed out on those gains because it simply wasn't added to the fund. Those investors only acquired Google after the announcement was made, the stock price jumped up, and then added to the S&P 500 fund. VTI's holdings of small and mid-cap companies potentially allows it to outpace VOO in the long run. There's higher risk with small and mid-cap companies, but also potentially higher rewards. VTI has extra diversification, about 3,000 companies more than VOO, but the extra 3,000 companies only make up about 20% of the fund. I don't plan on cashing out my investments for several decades, which is why I invest in VTI. But if the idea of holding large stable US companies is more comforting to you, then investing in VOO may be a better play. In the end, you should be investing in whatever keeps your mind at ease and allows you to keep investing more. Let's keep this conversation going and let me know which you like better, VOO or VTI. I'll see you all in the comment section below. Peace.